Hi believers, this is Shubham from the Waya team and I am here to provide our weekly bite and the roads ahead in the market. Indian equities benchmark Nifty posted a loss of 0.5% week on week and ended in red for the third consecutive week. Broader market also remained weak with the mid-cap and the small-cap indices underperforming the larger peers. Mid-cap index lost 3% while small-cap index lost 4% for the week. Nothing much has really changed since last week, and the reason for declines remains same, mainly persistent foreign investor selling, weak corporate earnings, and slowing economic growth. Center's capex needs to expand by 65% year on year between December and March to meet the FY25 target of rupees 11.1 trillion, which now seems unlikely, and hence infrastructure stocks are also taking a hit. Management commentary continues to remain weak for many stocks, further putting pressure on market sentiments. However, due to this sustained sell-off in the market, the Indian equity valuation has now dropped to its lowest level in the last 30 months. The benchmark Nifty is now trading at price to earnings multiple of 21 times on a trailing 12-month basis, which is lowest since June 2022 when the multiple was 19.5 times, which now gives a hint that market is unlikely to fall much further from here. However, for the sustained upside, some of these challenges could include uncertainty surrounding trade policies under Trump's administration, with the severity of restrictions likely influencing the performance of export-focused emerging markets such as India and China. On the positive side, possible easing of inflation to 4.2% in FY26 can create a room for rate cuts by RBI, hence turning the sentiments positive. Talking about the crucial Nifty levels, 22,700 will act as a crucial support for the index. If the index slips below the level of 22,700, then we may witness a further correction up to the level of 22,500. While on the upside, 23,500 and 24,000 levels will act as a big hurdle for the index. Also, now Nifty is facing a selling pressure on every recovery attempt, which signals a continuous bearish sentiment as of now. All eyes are now on the budget, and we are very optimistic about a capex heavy infrastructure oriented budget targeted towards development rather than targeted towards providing freebies for individuals. This will drive revenue and earnings growth for the next few years. Multiple events like upcoming union budget, RBI policy, and ongoing Q3 FY25 result season will continue to shape market movements over the next fortnight. Recent economic data point, HSBC's PMI survey revealed a slowdown in India's private sector growth in January month. While manufacturing activity showed resilience with a PMI rising to 58 from December's reading of 56.4, the services PMI fell sharply to 56.8 from 59.3 in December, the lowest in over last 2 years. This needs to be watched for next month also if it is a temporary blip or a sustained slowdown in services sector. Coming to the result update, one of our recommended multi-bagger stocks, Supriya Life Sciences, reported a very good set of numbers. Revenue is up by 33% and profit is also up by 57% year on year. We continue to hold stock to gain most out of its solid earning momentum. Concluding, we believe while the current sentiment is cautious, we should focus on long-term investment rather than short-term gains. One might look for opportunities in dips, especially in high-quality stocks that have been oversold due to FII's selling pressure, but earnings are coming good. That's all for today. Wishing you all a very happy Republic Day and a happy profitable week ahead.